Raghuram Rajan announced his maiden monetary policy and surprised the bankers and the corporate sector. In the mid-quarter monetary policy review, Reserve Bank has hiked the key repo rate by 25 basis points, which now stands at 7.50%. Repo rate is the rate at which banks borrow money from the Reserve Bank of India. Meanwhile, the cash reserve ratio, or the amount of money banks have to park with the RBI, has been kept unchanged at 4%. RBI also reversed some of other rupee supporting steps. He relaxed the requirement that banks meet 99% of their CRR on a daily basis. Banks will now have to meet 95% of their CRR on a daily basis. RBI has also decreased the marginal standing facility by 75 basis points to 9.5%. Reduction in marginal standing facility will bring in marginal liquidity in the market.
Recognizing that inflationary pressures are mounting and determined to establish a nominal anchor which allows us to preserve the internal value of the rupee, we have raised the repo rate by 25 basis points. The intent here is that when the repo rate becomes the effective policy rate, it should be consistent with inflationary conditions in the economy. On net, these measures will reduce the cost of bank financing substantially while allowing us to take an appropriately precautionary stance on inflation.
RBI's rate hike has disappointed the banking industry and millions of consumers who are struggling under the burden of high EMIs. It would also dampen sentiments ahead of the peak festival season when banks expect demands for loans to go up. For an instance, if you had bought a house worth 30 lakh rupees at 10% interest for 15 years tenure, then with an increase of 0.25% in interest, your EMI will rise approximately by 500 rupees. The central bank's move to hike rates is aimed to rein in rising inflation. India's retail inflation is around the double-digit mark and headline inflation hit a 6-month high in August. Business Desk, DD News.